Hi everyone, welcome to our quarterly Mortgage Trend Series webinar. Before we dive into today's topic, I'm going to run you through some items that help you best leverage our webinar platform. Your dashboard is interactive and customizable. You can personalize your view by moving, resizing, or hiding different elements on the screen. Simply use the corners of each icon to adjust the size or position of each box. We encourage you to engage with us using the interactive tools. If you have any questions throughout, please submit them using the questions box on the lower right-hand corner of your dashboard. We will do our best to address your questions in real time. You will also notice a survey on your dashboard. Please fill this out anytime during the presentation. To let us know your thoughts throughout the presentation, use the emojis. To access these emojis, you can click on the smiley face on the right side of your lower banner. Your feedback is valuable to us, and we do use it to craft future webinars. So please fill out that survey, use your emojis, let us know your thoughts on this webinar so that we can keep making these better in the future. For those of you who are seeking CPE credit, you will need to answer all 4 poll questions during the webinar. CPE certificates will be sent out via email within a couple of weeks, so be on the lookout for those. Lastly, this session is being recorded. You will receive a link to the recording within a couple of days. If you want a copy of the slide deck, you can download it now from the left side of your screen. That'll stay live through the whole presentation, so go ahead and download that before you log off today. Now that we've covered all the details, I'm going to turn it over to Seth Sprague to introduce today's topic and our presenters. Take it away, Seth.
Great, thanks, Gabby. And before we start off, just for anyone that doesn't know who Richie May is, we've been in the industry about 40 years, dedicated to the mortgage industry, and full suite of services, including cyber, business intelligence, whatever I do for the firm, audit, tax, etc. But really focus on mortgage banking. But enough about Richie May, because we got a jam-packed agenda today with a special guest. So the agenda today, real quick, Tyler will be he'll kick us off today with the Q1 kind of landscape and a little bit of Q2 on the Richie May Select participants. And then most of the presentation today would be, unfortunately, me, and fortunately for you, Isaac Boltansky, talking about a lot of macro trends in the mortgage space and what might be going on or not going on in Washington, D.C. I'll do my introduction, then I'll hand it over to Tyler, and then Isaac, and then Tyler will take on the presentation. I'm Seth Sprague, CMB, Director of Mortgage Consulting here at Richie May. Been in the industry about 30 years. And super happy to be on the panel again today. I'll turn it over to Tyler. He could give a quick introduction. Then it'll be Isaac, and then Tyler will start with his part of the presentation. And I think Tyler's on mute.
Oh, that's webinar 101. Go off mute when you're trying to speak here. But anyways, I'll try that again. I'm the Director of Data Analytics at Richie May. That encompasses our BI solution tailored for mortgage banks. And then also we have several benchmarking products that we can deliver to mortgage companies. And one of those of which we'll take a look at today. I've spent my whole career in the mortgage industry, most of that time at Richie May advising clients, but I've also had financial leadership roles at mortgage lenders. Isaac?
Hey, everybody. Thank you again for the invite. My name is Isaac Boltansky. I am the head of public policy at PennyMac. My job here is to cover everything from a legislative and administrative perspective that can impact our business or the mortgage ecosystem. Before that, I spent about 15 years on the sell side following financial policy at different broker-dealers. Thanks for the invite.
Great. Well, with that, let's, Seth mentioned that we got a jam-packed session, so let's jump in here. We're going to start it off, though, with a poll question. And as we mentioned earlier, you do got to answer all 4 poll questions if you want to get CPE credit. Even if you don't want CPE credit, your participation is appreciated. But here's our first poll question. Wanted to get really a gauge on the room. Really, how is your financial performance and your production levels been in 2025? I'm really curious, as you guys were planning in 2024, is 2025 turning out as you expected from that perspective on a financial and production perspective? Is it better than expected? or is it worse than expected? I certainly have a take based on the data that we see, but would love to really hear, what everyone who's got boots on the ground here is feeling, now that we're almost halfway through the year. And you do got to answer all four, just as a reminder, if you want that CPE. But it's pretty easy. You just got to click that button, and we'll get the results here pretty quickly. Almost there. All right, so that looks like we're about 70%, which looks like the majority. So I'm going to go ahead and advance it. Let's take a look at what those results were. And so here we go. So we've got the majority, 61% as expected, which is no surprise. I think 2024 and 2025 have been very similar. So I think that was my expectation that 25 would be pretty similar to 2024. But then if we move on from that, the other two options, it looks like better than expected is maybe a little bit a larger piece of the pie than worse than expected. So that's good to hear. And it's always a little bit dangerous to ask some of these questions before you're going to present on it. But I think we're generally aligned, and we'll talk about some of those things as we dive into the numbers here. So I'm going to talk about the Q1 mortgage landscape trends. And as a reminder, most of you know that a lot of this data that we present on comes from our benchmarking program, Richie May Select. That program includes 75 IMBs who participate quarter in, quarter out. And it really covers financial, production, personnel, and several different KPIs that are important for managing your own financial performance. And so we'll take a look at those Q1 results. That's the bulk of the data that we're using for this presentation. And so if we dive in here, I want to take a quick look at how Q1 really compared to Q4. So on the left-hand side of this slide, we'll see Q4, the pre-tax net income was an average of 6 basis points, and that's 6 basis points of origination volume. About 52% of lenders were positive in Q4. And then if we fast forward to the far right side of this slide for Q1, we're at a loss of 12 basis points. So there's about an 18 basis point delta, and we'll go over really what's driving the delta there. So first off, servicing. So servicing, and I want to be clear on this one, servicing did account for like a 36 basis point change. But again, that change is in the perspective of origination volume. So no, I'm not saying that servicing values decreased by 36 basis points. That's not at all close to what happened. But the servicing adjustment, which would include fair value adjustments, it would include decay or runoff in the portfolio, amortization of the portfolio, or any adjustments related to selling off portions of the portfolio would be included in this servicing adjustment. If you have a fair value write-up to the portfolio, you'll see this as a gain on the income statement. If you have a write-down, you'll generally see this as an expense. And what's going on here is in Q4, we had about a 9 basis points increase in the MSR value among our peers. In Q1, though, we had about a 2 basis point decrease in the fair value. So that's the bulk of it. And when you also consider the decrease in production volume in Q1, that really does, make this a 36 basis point bad guy to this P&L quarter over quarter. The other item I want to touch on is secondary margins. So secondary margins, this is one of the bright spots of Q1. They increased 25 basis points over Q4. And so this was like a $750 per loan increase, and it brings margins for Q1 over $11,000 per loan. Now that's important and that's significant. That's actually going to be the highest margin on average that we've seen for the retail peer group since 2021. So that's important, I think, for the industry to get back to sustainable profitability. We got to see margin increase because I think a lot of the increases in our costs are here to stay. I don't think we're going to get back to, levels that we saw before COVID. I'm not sure if we'll ever get back to those, but we're certainly not getting back to them anytime soon. The other aspect, as we move to the right on this chart, would be the pipeline. So the lock pipeline, which will include really that mark to market on your lock pipeline, as well as the open trades, all related to locks. That accounted for a 23 basis point increase during the first quarter. And, if we look at prior Q1s, this is really right in line with the type of gain that we see in a Q1. Most of the time Q1 pipelines are growing compared to where they were at 12/31. So pretty normal to see a gain here, and that's nothing that we didn't expect. On the personnel front, we did see a 12 basis point good guy here. But this is maybe a little bit misleading because it's really not an indication that we made improvements on our personnel costs or changes to our personnel cost structure. What's really going on here is that in Q4, we had a lot of bonus payments for annual bonus incentive plans. And in Q1, those just weren't relevant. And so that's part of the good guy there. The other thing I'll mention too is, this in prior Q4s before 2024, I think that the bonus impact has been a bit less. As the industry has struggled, we've definitely heard of a lot of companies either officially or unofficially really suspending their bonus plans. And in 2024, 70% of lenders were profitable. And so I think a lot of those bonus plans came back. And so, that's a positive change, but not really a significant change in terms of on a go-forward basis. And then operating expenses, this was pretty flat. I think that there was some small decreases on a dollar basis quarter over quarter, but really no significant changes to OpEx. Then finally, that leaves 43 basis points of impact, and that would be accounted for by a decrease in origination volume. Origination volume was down 16%. I think part of the reason for the decrease is simply because we had a unseasonally high Q4. But the other thing I think that this chart or this part of the graph really highlights well is it's a really good indication of where I think IMBs really are today. Most IMBs they've cut the majority of the expenses that are there. There's not really a lot of meaningful expense cuts to be done. There's probably a few out there who still have some, but for the most part, that's where most IMBs stand. And so IMB's profitability is really going to go where volume goes. If we see increases in volume, we're going to see profitability, improved. If we don't see increases in volume, we're going to see profitability suffer. For 25, I think the MBA's forecast is we're still at 5.7 million units. So still not a great year in terms of units. I think that's pretty on par with what we saw back in 2014. But hopefully as that grows, we'll see more sustained profitability. Moving on from Q1, and this is kind of my take on what we're looking at in 2025. Has it been better? And I'm very encouraged by the data that we can see so far. So in this chart, we're looking on the left side with the blue bars. We're looking at the percent of lenders that have a positive net production income. So net production income, a little bit different than pre-tax net income. For net production income, we're really trying to isolate the origination platform. So there's no servicing activity that goes into these numbers. And what we can see is that we're seeing modest increases in the number of lenders that are able to be profitable during Q1. So 24% is where we're at for Q1 of 25. That was 19% in 24, and that was 10% in 2023. So, they're not necessarily great numbers, for just 1 in 4 mortgage lenders to have a origination platform profitable business in Q1. That's, not amazing numbers. I don't think anyone's shouting for joy. But for some context, if we go back to 2018, so 2018 was 33%. So 1 in 3 lenders had a positive net production income. So, I know 2018 wasn't the greatest year, but it still felt like more of a normal market. So I can, see the signs that we are continuing to see improvement year over year. And I'm encouraged that, that this can continue and help, help IMBs be more profitable and more sustainably profitable. The other aspect that makes me feel encouraged too is that, even beyond Q1 financial performance, if we're looking at 2025 production numbers year to date, we can see that the production is better this year than it was last year. So on the left side, we got applications here, and applications year to date are up 16% versus the same point in time in 2024, and locks are up 19% versus this same time in 2024. So these things all have me encouraged that things are moving in the right direction, and that things are getting better, and that 2025 could be good. On the other hand, there's also a lot of volatility in the marketplace and in the political environment. So there's a lot of things that that are going to play out that will or could possibly have significant impact on 2025. That's not what I'm going to talk about, though. I think that's more of Seth and Isaac's discussion that they're going to jump into. And so with that, I'll hand it back over to you, Seth.
Great. Thanks, Tyler. And I think from the perspective of what we learned at secondary, and there is a poll question up for folks, which is going to start kind of the political side of this conversation, but inventory. Nobody was complaining there was lack of inventory for homes for sale. It was all about affordability. So I think your graphs and your data is consistent with there's people buying homes, but there's a big affordability problem. But there is homes that can actually be purchased. So I think that is the trend, and that's why the data kind of shows what it does, and we'll see how the rest of the year plays off. And for those, just as a quick reminder, you got to answer all 4 of these poll questions to get your CPE credits. But the question that you've now been staring at for a few seconds is, will GSEs exit conservatorship during this administration's term, i.e. under President Trump? And so this is going to kick us off into a conversation about exiting conservatorship. And I was Googling something, Tyler, while you were presenting. And so in 2008, there were actually really 2 material things that happened. One, Britney Spears did go into conservatorship, as did Fannie or Freddie, and yet she's gotten out already. She only spent 13 years in conservatorship per the internet, which we know is always truthful and never inaccurate with its numbers. So let's go. I'll go to the next slide here. As we got about critical mass here, and the answer is maybe. All right, Isaac, they're teeing us up for this pretty well here. And before we get into this kind of GSEs exiting conservatorship, fake news, real news, etc., let's talk about what exiting conservatorship means and what privatization means, because I think as an industry, and I know you've done this on other panels, but that's not one and the same, right? They could exit conservatorship, but taking them private is a second step to that. And so, Isaac, can you just kind of kick off there with your thoughts on exiting conservatorship and then privatization, because those are really 2 different topics that we need to kind of walk through.
Yeah, look, I think there's an inherent silliness to some of the way that this is described, and there's definitely an inaccuracy at the core of some of it. But just to start with, Seth, I think that the audience poll response was right. Maybe. And, for a year now, I have said that it is possible the GSEs are going to exit conservatorship. It's just not yet probable. You have to see a lot more movement before you can say that that's your base case. There are hurdles on the road between here and that off-ramp on conservatorship. But just to answer your specific question, the U.S. government is always going to have a direct and significant role in the residential mortgage market, right? And so when folks talk about privatization, sometimes they get spooked, suggesting that the government will not have a role, that we will end our support of the GSEs, and that will have massive implications throughout the MBS markets and really the broader economy. So I'm here to tell you, Seth, Uncle Sam is still in the housing business, and they will be for the foreseeable future. So when we talk about privatization, it's generally referring to the legal status of the GSEs. And here we're talking about ending the 16, almost 17-year-long conservatorships. And so I think that is what we talk about when we talk about privatization. Because you got to keep in mind, Seth, and I know we're going to talk about this, the GSEs are already public companies. They trade on the pink sheets, but they are still public companies. So I think that it's important for us to bifurcate those things, because that word privatization means one thing on Wall Street, it means another thing inside the Beltway here, and it means another thing to everybody else. So I think it's important for us to delineate.
And let's talk a little bit about what their structure is today versus when they went into conservatorship. And as I was thinking about this presentation, I was like, with COVID, right, it was really easy to say, hey, let's just shut things down, right? Everyone go home for 6 weeks. We're going to shut the economy down, and then we'll figure it out what we're doing. Well, we sort of did the same thing with Fannie and Freddie, right? We threw them into conservatorship, and now 16 years later, we're trying to figure out what does it mean to actually restart them, right? They have significantly less whole loan portfolios than they had going into conservatorship, right? Most of their dollars that they made pre-conservatorship was off of a whole loan portfolio where they own the credit risk. Today, they make their money off of the G fee, right? And have very little portfolios. There's been a lot of tightening of if they even have a portfolio anymore, which is why, the industry talks about, well, they won't buy these loans, they won't buy these loans. Well, they don't have a portfolio anymore. So their structure is different. Their risk is different. So let's talk about sort of their risks, explicit government guarantee risk capital. Look, at the end of the day, they are different entities today than they were when they went into conservatorship. And if they came out of conservatorship, they might be different entities again. And that's, I think, where you and I kind of go, this is a very complex problem, because people just want to say, well, don't affect the TBA market, or don't affect mortgage rates, or don't affect, but it's, as you start to peel apart that onion, it gets very complicated to kind of see what do they actually look like if they weren't under conservatorship.
Yeah, there's a lot there, and I think just as level setting, my wife had twins 2 years ago, and I love these companies so much. I tried to name those twins Fannie and Freddie. My wife would not let me. She wouldn't let me do Ginny or Sally either. But still, I love these companies, and I think that part of it is I've been around long enough to know the companies before, to know them during conservatorship, and to know them now. And these are fundamentally different companies. Now, of course, the main business line is the same, but you have to give them credit for the changes that have been made. Everything from CRT to PMIERs to the LPA grids to minimal portfolios to pretty smart and I think forward-thinking pilots to what is an incredibly robust capital rule, perhaps too robust. In places. So these are fundamentally different companies. And it's one of the reasons why, Seth, I've lived through this now where for 15 years, new staffers would come into Capitol Hill and say, we're going to have our big GSE reform moment. It's going to be that big vote on the Hill, like Mr. Smith goes to Washington, which is nonsense, right? Because the GSEs have been reforming for the past 16 years. They are different. And look, I think there's actually pretty fascinating PhD thesis that could be written around the idea of these companies had their profits swept. Every dollar that they earned above a certain threshold was swept. So they didn't worry about quarterly earnings or any of those types of things for a while. They did spend a lot of money on tech and people. Now, not always in the right places, to be sure, but their motivations were different, right? And I think that should be part of the conversation. When we talk about yeah, sorry, go ahead.
And I was going to echo that for a second, right? I mean, the pre-conservatorship, I think people sometimes forget that as a publicly traded company with shareholders, there was a lot of pushback on repurchases. And I know we've had a little blip on repurchases around COVID, but at the end of the day, their incentives are different under conservatorship than they were as a publicly traded company with answering the stockholders as opposed to answering to the FHFA.
Yeah, and COVID provides us with a little bit of a framing for talking about this. The GSEs were in conservatorship during COVID, which allowed for the FHFA to mandate and to bless some of the company level work that was done to standardize the policy shifts that were needed to respond to COVID. Right? I don't know if they would have had as much leeway or acted as quickly if they were out of conservatorship. We'll never know. But I think one of the big questions, Seth, when we talk about there are a couple, right? There are sort of the political questions, right? Where one is, what is the government going to do with the $340 billion that it's owed in the senior preferred or the 80% equity, and how does that play? Within that, you have questions about what does this do for mortgage rates, and we can talk about that all day. But I think one of the questions that does warrant some consideration is, does the FHFA have the regulatory musculature to police these enterprises outside of conservatorship? A lot of what they've done over the past 17 years have been using their conservatorship authority, right, which is incredibly powerful, but that goes away when they exit. I'm not saying that should stop it, but it's just one of the important questions that should be asked.
Yeah, I think you and I would agree that transition for the FHFA from a conservator role to a regulator role would be difficult and probably need to be staffed differently. And again, that may present some incremental challenges in the mood of DC today. But we'll see how that goes. And that gives us an opportunity to kind of pivot to the next question about regulatory capital. And you and I have been at some of the same events over the last month or so, right? Where, you hear this, you hear big banks say this, you hear Secretary Treasury say this. Look, a year ago, 2 years ago now, Basel III Endgame was the hot topic, right? Gold standards. we're going to do this to the banks. We're going to hammer the banks. And then a lot of the industry, the Mortgage Bankers Association, Housing Policy Council, many other groups said, hey, wait a minute, do you really want to do this? They sort of retooled the rules, but then we had an administration change. So Basel III Endgame certainly, from my opinion, seems off the table, at least as far as gold plating it. But is there some potential like relief that could come from this administration, potentially, when they start to focus in on that side of the house, when it comes to maybe some regulatory relief for some of these large banks, or even banks above 250 billion of total assets?
Yeah. So there are a few things. Number one, and I think they should be separated. Number one is something called the supplementary leverage ratio. This will be changed. It will occur this year. I can't tell you exactly what it's going to look like, but effectively what it's going to do is allow for large banks to purchase more treasuries and to do so without a capital hit, having to hold additional capital against that. Maybe it's in the form of a haircut. Maybe it's a total exemption. I don't know, but they're doing something there. And Scott Bessent, the Treasury Secretary, has said that will push the 10-year down 70 bips. Now, Seth, I think I might have stolen this from you. All models are wrong, but some are useful. I don't know if it's going to be 70 basis points. I'd probably take the under, but we've seen this before during COVID, and it was 20 to 30 bips, right? So it's meaningful. On the other end, I try to highlight this to my folks a lot. We are going back not to the first page on Basel III Endgame, but we are going back. They are going to restart, think about this more holistically. All of that, I think, is good. I also think it's good. The industry did a great job hitting back on the warehouse lines issue in particular. And so I think there's an opportunity to play offense there and really underscore the importance of some of these financial plumbing arrangements that frankly, I don't think regulators understood in the last go-round. But that is something that is not going to get done this year. They're going to start this year. It's going to take all the next year, and it'll be into the year following before you see anything, I think, tangible.
And for many of our folks on the call, and for many of the folks that sell you loans at PennyMac, right, we've got a lot of non-banks on, and they're probably at this point going, what do I care? I don't care about banks. You do care about banks, because if all of a sudden you could get better treatment on your warehouse line, that will lower your cost. And as Tyler's numbers sort of pointed out, right, like every basis point matters today. There's nobody projecting this huge refinance wave anytime in the next 3 to 4 years. So if you could get your warehouse lines cheaper, that's good for you. If we could get treasuries down and we could get mortgage rates to follow, that's good. And so, again, while it's not – this is where I think sometimes, and I'm going to say this in all nice I can, sometimes the IMB is like, why do you care about the banks, Seth? Why do you keep talking about the banks? Like, because the banks are the one funding you. And if they have cheaper cost of capital or more capital, they could do more things with you. And so I think that's where I just always want to try to connect it back to probably many of your clients at PennyMac that sell you loans, and many of our clients that are non-banks. Look, this is very important. A healthy bank, a bank with more capital, that's good for everybody.
Yeah, and look, I think this set of regulators agrees with you. We are still waiting. Part of my frustration is we're still waiting for clarity as to who the FDIC chairman will be. Travis Hill's in an acting seat. We're still waiting for Jonathan Gould, who is one of the most qualified candidates you can have to run OCC to get confirmed. But luckily, we've got Governor Bowman done at the Fed. So things are moving. They are going to be receptive. And I think that they're going to take their time and also look at this more holistically from a total capital and liquidity burden perspective. I can tell you some of the banks that I talk to, some of their lobbyists are also going to work to look at some of these thresholds, Seth, like this whole construct of the 10 billion, 100 billion, 250 billion. First off, these were all just made up, right? Yeah. But they were also made up a long time ago. And so, let's look at one or the other and see if we can shift it around a bit.
Being an old model guy, as you know, right, 249.9 is good, 250 is bad. That creates a cliff effect. And anytime you start creating cliff effects when it comes to capital or liquidity or different standards, you get behaviors sometimes that, one, if it's your modeling is unhedgeable, but more importantly, too, creates like these abnormalities within the industry. So again, and the other thing I'll just point out is, and remember, Ginnie Mae came out with that all participants memo at the end of last year, giving some capital relief for the mortgage servicing rights to non-depositories, right, that could effectively hedge. Boy, wouldn't that be great for banks to get that same sort of credit?
Yeah, look, I don't know if I'll comment on that one in particular, but I will tell you that I am excited for all of us to have this conversation with this group of folks. I think very highly of Michelle Bowman. I think very highly of Jonathan Gould, and if it is Travis Hill, I think that there are a few people who understand statute better than he does. So I think that we'd have a real opportunity to make something that's hopefully lasting. Which, look, in our world, with the way the regulatory pendulum shifts, depending on who's in 1600, it'd be really nice to have some firm capital and liquidity rules for banks.
It would be, and that would really pave the way for a lot more opportunities for non-depositories to create different loan products. Banks' balance sheets would open up. It would help overall with liquidity. I'm going to pivot to our next poll question here. Remember, you got to answer all three, and they don't allow me to answer these because I would like I'd be somewhere between D, E, and I'd have a G, whatever Isaac tells me I should read. Is how I get my news. But we just thought it'd be kind of a snarky question to ask. Like, where are you getting your news coming out of DC from? You know, are you on Truth Social? Are you getting it from X? Are you reading something else? I mean, there's all sorts of news sources that are out there. I personally don't get much time to watch TV, so I don't follow much of that anymore. And I do listen to sports talk radio on my way in and out, so I can tell you what's going on in that sense. But I think where people get their news is having some influence as to how they're sort of behaving in this market and what they're thinking about. And then, as Tyler and I were joking earlier, you see a news headline and you're like, what does that headline actually mean? And what are they trying to convey here? Because like, you could literally turn on two different channels. They could be reporting on the same story. And you're like, are they talking about the same thing? Which is, you know, a different world than we used to live in, certainly. When I grew up, how we used to ingest news. So give folks a couple seconds here to answer this one. And Isaac, we should have put, you know, Isaac's old newsletter as the way to get most of the news.
Yeah, it's gone.
It's gone.
Yeah, look,
I miss it. That's the one thing I read every week.
The news has become a choose your own adventure book, right? So,
yeah.
I think in a lot of ways it's tough, but I try to challenge myself to read things I wouldn't normally read. But it is hard.
And so let's we're going to publish these results here, and I'm glued to the broadcast news stations, feeds, subscriptions, sports talk radio. I got 7%. It's disappointing. So I'm somewhere in the disappointed of I avoid the news or I listen to sports talk radio. But, you know, there's certainly a lot of ways to get it. And this is a great pivot, Isaac, into probably one of the biggest, if you Google it and you just any feed you're on, it's a perfect segue into the one big, beautiful tax bill. And what does this mean for the mortgage ecosystem? And look, you could give, and Isaac, I want you to give your opinion. You're in DC. You have your ear to the ground on this. But from my standpoint, and again from the mortgage standpoint, let's tie this into mortgage. Mortgage rates are going up because this bill is going to add to the deficit. And I don't know a lot about economics, but when you keep spending more and your debt keeps going up, at some point your rates go up. And so as this bill sort of has migrated along, you saw the long end of the curve jump up. Now it's come back a little bit. Is it tariffs? Is it the tax bill? But let's talk about this tax bill potentially and some implications for the mortgage ecosystem, good, bad, and different. And we can certainly talk about rates.
Yeah, so a few things. Number one is one of the technical definitions of politics is the apportionment of a finite amount of resources, right? And that kind of makes sense, right? We elect these people to lead us to a certain policy outcome and do so with what we have and marshal those resources. Neither party has done that for 25 years plus, right? So Deeply frustrating. I don't know when that's going to change, but let's just throw that depressing point into the conversation. In terms of your actual question, I think about this through two different lenses. Number one, housing. Housing did pretty well, Seth. Like if you go through the House bill, we've got the LIHTC, got the SALT cap being increased. Mortgage interest deduction is kept at the existing levels. There's some 199A stuff, which I know you and everybody on this call cares about for pass-throughs. Not only is it made permanent, it's also increased and the applicability is expanded. It's really a triple play and good things on that end. So housing, all things considered, did pretty well. I mean, there was some hope that we might have some supply provisions in there, but those didn't make it. But look, I think it was a win for housing. The other lens is through the economic lens, and this one's tough. We throw another $3 to $5 trillion into the deficit. That's meaningful. And I just don't know when it breaks, Seth. Like, I don't know how much the market's going to care, when it's going to care, or if we're just going to end up, and by us, I mean U.S. Treasuries just still being the cleanest dirty shirt in the laundry, right? Which we have been.
And so let's decouple the SALT, because I think this, and again, I'm trying to avoid the news as best I can, but one of the things on the SALT deduction, right? It was another hard cap, right? $10,000 under the previous bill, which is 2017. This takes it up to 40,000, I believe. Correct? Are they indexing it, or is it just a hard cap switch?
It's going to be, and it's going to change 4 different times. So I don't know how useful it is for folks to count on the exact specifics of it right now. I'll notice that the Senate Majority Leader said there's not a single Republican senator who cares about SALT, which might be right. So look, I don't think it's going to be 10,000. I think it's going to end up being closer to 25,000. We'll see what the specifics are. I think it has to go higher. I just think 40,000 is going to be too much at the end of the day.
Yeah. But anything will help on the tax side,
yeah.
on personal income tax side, right? If you can bring that back in for people, that changes their tax bill, which again is a stimulus to the economy, so theoretically. And the 199 deduction, obviously, that's designed just so people remember. That's sort of trying to level set like the S corp C corp problem, right? That's all trying to normalize those two things, and quite frankly, increasing it for the vast majority of your clients and the vast majority of our clients. That's a great thing.
Yeah, look, there's a reason that the REIT structure has been so successful since the 60s, right? We want these types of investments to be accessible to individuals, so that's part of the story, and the rest is just the growth of S corps generally. Like this was always a no-brainer layup just from a small business perspective.
Now, and again, to pivot, and I love the way you broke it between the housing side and the economic side. Obviously, this bill, again, deficit spending by definition is going to cause that longer end of the curve to pivot up. And we should probably have an economist on the call, because you and me doing economics, we're going to get our signs wrong and we're going to get the magnitude wrong. But at the end of the day, you've got one side jawboning, Powell, you need to cut rates now. On the other side, you're passing a bill that's going to be inflationary, which causes the long end to go up. Fed has no control over that long end of the curve, nor does Fed. Fed has modest control, doesn't even have any control between the spread and mortgage rates, which is historically wide. Now, the Treasury could do something about that, like saying, hey, we're not going to sell our bonds, we are going to sell our bonds. But at the end of the day, it appears like, to me, Isaac, what we're headed to is sort of that dreaded bear steepener, right? Short end of the curve pivots down, long end stays or pivots up. Steep yield curve, good for banks, maybe not real good for mortgage rates.
I have enough well-earned humility when we talk about rate projections to know that I have no clue. But I do think I think your framing is absolutely fair. I also think, and this is where I do have perhaps a little bit more insight, is I do think that this Fed, and in particular Fed Chairman Powell, who is going to leave this seat next year, is not going to bend to much of the jawboning pressure. I think that, in fact, the more pressure that you see, the more difficult it is for him to lead the charge lower. Furthermore, we've got to keep in mind, and this will become important because he will be replaced next year. Ultimately, the chairman is important. He is meaningful in marshaling forward the agenda and framing market expectations, but he is but one vote on the board, and I think that's important to keep in mind.
Yeah, and I do think he'll fill out his term. So we've got.
I mean, there's been chatter. We're already starting to get chatter of who the next Fed chair nominee could be, and I have no idea. Right? You have your names from Kevin Warsh to Jim to McKernan, the CNBC host in the morning. You've heard everything from those ends, but I think it's important to know that the Fed monetary policy is still made by a board decision.
Yeah. And people do rotate in and off that board on a periodic basis as well. So that influences how dovish or hawkish they can be as well, right?
Yep.
Okay. So we've kind of addressed the one big, beautiful tax bill, which all your news feeds are going to cover out. What can Congress do? And this, NBA at their advocacy council, this was one meeting back in April. I mean, this was one of the topics of what can Congress actually do to address sort of affordability or housing shortfall. And again, like we already have, right, Fannie and Freddie, we've got VA loans, we've got FHA loans. We already got them controlling the lending side of the house. But there's limited that they could do there on that side of the house because ultimately, as I'd like to remind people, those mortgages all get packaged into bonds, and the bond holders are going to want a certain risk tolerance and profile and return. But is there anything that they could do out of Congress to try to just move affordability in a certain direction or address anything in the housing side that's macro? And I know a lot of this ends up being very micro, right? This town's going to do this town's going to do that. But what could Congress actually do here? Because this is where I think there's sometimes a disconnect in our industry was, why doesn't Congress just go do this? I'm like, I don't think they can. But you sit there in D.C., what can Congress do?
I mean, so there are a few things at the margins. Like I think that clarity on the tariff side, so we know the cost of inputs, would be helpful. I think that comprehensive immigration reform would be helpful from a staffing perspective. I think those things will all help in the margin. But what I'm actually excited about, Seth, is in the first time in my career, housing affordability and the lack of housing stock is a bipartisan issue. Yep. And I know this because you have Senator Elizabeth Warren, who is very far left, Senator John Kennedy from Louisiana, who's very far right. They've been working on and talking about doing bills together on this front. And they're predicating it on the realization that the only time that the federal government has been able to get states to do what it wants was when we changed the drinking age and when we changed the speed limits, right? And both times they withheld federal funding until states ultimately complied. And I think that's part of what they're kicking around now is this idea of, look, this is not something the feds have a magic wand for, but maybe we can influence states and municipalities to do zoning reform so we can get that density dynamic that we need. It's not perfect yet. It's not a panacea, but I am heartened that we're finally at that point where they realize you can't just fix this with lending issues, with lending changes. That's pushing on a rope. We need more stock, and they get that. But look, it takes time to pass a bill. It takes time for that bill to flow through the states. It takes time. All of it takes time.
And for those that have never seen Senator Kennedy in a hearing, he usually asks the participants of the hearing if he always asks them the question of, hey, what is your philosophy on the economy? Are you a free economist? Like, do you believe in free markets? Because he's certainly, like, to say that Kennedy and Warren are working on anything, you would assume that's like a Kennedy relative from JFK and Warren, not the senator from Louisiana.
But this is part of, the ideological spectrum is turned into a horseshoe. And there are areas where the populist right and the progressive left agree. And it's everything from credit card interest rates to drug prices to now, housing affordability.
And the other thing, and you can comment on this, Isaac, and then we're going to go to our next poll question. But at the end of the day, the rhetoric, at least out of this administration, you hear less of the, hey, why don't we give these credits like they've recognized the fact that like trying to drive the demand higher for housing isn't the right answer until you address the other side. So that at least seems like that's off the table for now, right?
Yeah, look, I think that's I would say that's off the table. We'll see where the FHA actuarial fund sits in November. We'll see where that is. But I think there's definitely well earned caution on that end. I would also say I think that this administration is trying to reset some of what I've referred to as the Biden era beneficence, right? I think that they're trying to make like the FHA waterfall a little bit more sustainable, right? Make it so that you don't have as much churn there. VA, we have the same issue with the VASP being pulled back, but hopefully we're going to get a VA partial claims bill done. So I think there's definitely what they believe is intended right sizing of benefits across the value chain there.
So it's heartening to hear that we've got consensus from kind of two extreme sides of either party to address sort of some of the housing implications that are going on. Less rhetoric about trying to juice demand because they realize that there could be an undersupply of homes. So we're on our fourth poll question here. Remember, you got to answer all of these. But and again, this is kind of a what will the impact on tariffs? And again, I didn't check my phone. I mean, tariffs might be on again, off again today, 10 times worse than they were yesterday, or a million times better. But what will tariffs kind of be on the overall economy here for the second half of the year, whether it comes to do we end up in a recession? Do we end up with stagflation, minimal impact, business as usual, or actually get economic growth? And I mean, the whole tariff concept, we're going to kind of park for a second off to the side because we are going to want to come back and talk about a little bit about that lost claims activity when it comes to the VA side. But we're going to let our participants here answer kind of the tariffs question. And I don't know if you want to weigh in on this one, Isaac, but I think this tariff thing is a bunch of jawboning around stuff, and I'm not even sure what its overall impact is. I'm not even smart enough to figure out, like, is the price of avocados going up? Is the price of avocado toast going up, or is this just a bunch of jawboning around a bunch of jawboning because we want to make deals done? And I think that's probably where the uncertainty comes in, and that certainly was present in all the bank earnings. Was we just don't know what's going on, and that was even from some of our earlier poll questions today about just the great uncertainty of 2025. So we'll publish these results here. And as expected, almost a third, right? I don't know. And I think that's what the poll suggests here, right? I mean, yes, we could end up in recession. Yes, we could end up in stagflation. It could be minimal impact, or it could be economic growth. Almost a third for the first three answers. So again, short-term, long-term implications here have a lot to do with it. But let's pivot because we're going to run ourselves out of time as we always do, Isaac. Let's talk about you had led into this loss mitigation. Huge topic, right? Mortgage delinquencies, FHA delinquencies. We've lost the VASP program, which was the Veteran Assistance Service program. We're going to take those borrowers down to a certain rate. We have passed through the House or the Senate. I forget who passed it. House?
It got through the House.
Yeah, got through the House, sitting on the Senate. Is the Senate going to do something with it, do you think?
So the VA partial claims bill passed through the House on a voice vote. You can't get a post office named with that type of margin. So it was a huge victory. But I think the Senate's going to take a beat here. So I don't think that they're going to just accept that bill outright. Instead, there's been a new bill introduced by Senator Lisa Blunt Rochester from Delaware. She's a Democrat, and Senator Mike Rounds, he's a Republican. It's substantively similar with like 5 areas of difference, but effectively the same. And both bills are very, very good. Both bills, in my opinion, are undeniably necessary, given that there, estimates suggest 75,000 seriously delinquent VA loans out there. And I am optimistic that this will pass. I just think that we might have to wait until the fall, given timeline realities.
And then once we get so we level set, we get a bill passed hopefully this year. Then there's an implementation phase to get that done, right? So I was told even if they just passed the same claims process that the FHA currently has, that's still going to be 6 to 9 months before we could get something in there. So we're likely to see another maybe VA moratorium passed with some of these bills, foreclosure moratorium, or does that seem like off the table for this administration, more moratoriums?
I will tell you the Senate bill has some language encouraging servicers to not foreclose. I think that that's probably where we are with this, but it is a fluid situation.
Yeah. So this is another one to stay tuned. And if you're in servicing for FHA or VA, or you're selling your FHA VA loans to somebody like PennyMac, just remember that the rules of engagement for the servicing are a moving target in some instances, and can be a very quickly moving target. And that can have some impact on pricing and liquidity for certain segments or non-segments of that market. So just, again, if you're out there originating this product, you just have to be aware that, hey, it could get way better from here. It could get way worse. We could kind of stay in this limbo. But right now, we literally have no VA loss mitigation strategies that are available to servicers. There's nothing out there other than foreclosure. And so that's where, obviously, the House passed it. I think they said 435-0, right? That's like a Colorado Rockies baseball score game, right? I mean, and the Rockies are at 0. But at the end of the day, that's something to pay particular attention to, as are some of the changes at FHA. Our friend Matt Jones, who's sort of doing his work over there, we may see some changes on the FHA side as well. So again, stay tuned. People like PennyMac that have big Ginnie Mae portfolios that buy a lot of loans from our clients, they're going to evaluate this and look at the pricing. So pricing can get better or worse from here due to a variety of these factors. All right, one more before we go. I don't know if we've got any questions from the audience or not. I'm sure Isaac, we're smoking them with all this information that we're giving them. But if there's questions, please throw them in the chat there, and we'll get to them. But let's talk a little bit about credit scores. This is something you and I talked about in the prep meeting. And there's a lot of things that can be going on with credit scores, right? All of a sudden, student loan debt is now back in credit reporting, rising delinquencies, potentially job losses within certain segments of the economy. Talk a little bit about credit scores today. Inflated, realistic? Would you, from taking a credit stance, what do you think about the FICO scores today, or credit scores in general, I should say, not necessarily FICO scores?
Yeah, look, I think that we have had an extraordinary period over the past 5 years when it comes to not reporting things to credit bureaus, when it comes to the rise of things like buy now, pay later, and that whole genre of aspirational finance. That I think with all things at some point, the bill comes due. And so I don't know how many points on the credit score that's generated. I don't know. I don't have enough insight to those things, but I do know that it is an area of concern, I think, for this administration's housing regulators, in terms of getting whether we have a fair look at that and those trends.
And you mentioned the FHA insurance fund, and the FHA was still publishing it as of February, so I assume they're going to try to continue it. But they've got great detail on delinquencies on the FHA side that's publicly available to folks, and you can see there's a clear delineation below 660, below 680, below 620. FHA delinquencies certainly appear on the rise. As this administration sort of changes its loss mitigation strategy or thinks about that, we may end up with some housing inventory that comes back on the market as a result of sort of completing a foreclosure process, right? This administration is saying, geez, Isaac, we love you to death, but 3 strikes and you're out. You just can't stay in this home anymore. And so I think that is something for everyone to be aware of, that there are some opportunities out there to bring even more inventory out there, and maybe more at the affordable level. We've done a lot with reverse mortgages as well as an industry, which is keeping people in homes longer. And so we put a lot of seconds on homes too, right? So we've done a lot on the origination side to really sort of jam things up. And those are going to start to, the dam isn't going to break all at once, but the water's going to start spilling over the top here, and we're going to see more inventory come on, which is what we're seeing already in many states. So, to kind of try to wrap this up in a cohesive thought process as to where do we go next, certainly you want to monitor what's coming out of DC very closely. Whether it comes to the tax bill, whether it comes to changes on the servicing side, you want to make sure that you're aware and it's got material impacts on liquidity and values. We didn't really talk about it, but at the M&A landscape, Isaac, my personal opinion is that you're going to see bank mergers being accepted by this administration. So I think that's something to be aware of. And I don't know if you want to comment on that about bank mergers, but that's something that we're likely to see over the next 3 years is more banks merging, and that's going to have implications as well. What are your thoughts on the M&A side for banks?
I think it's one of the few things that you can say remains highly likely is that we have consolidation across the bank and non-bank spheres.
Yeah,
and now is the time to do it, right? It's during a Republican administration because we know that pendulum would swing back.
Yep, it could swing back and forth. Obviously, it looks like Discover and Capital One will go through. There's been other smaller bank mergers, so I'd expect keep an eye on mergers and activities. And finally, the other thing, just kind of as a massive takeaway here is, continue to monitor your vendors and counterparties. They may be reacting or not reacting at the same speed to some of these changes that are coming out of DC. And, this is where I'm going to go now, but they just didn't react as quickly as somebody else did when it comes to either changing costs or changing technology or changing product mix. And so, again, just be very cautious that, just because, somebody's got a great price today, they may not have incorporated in something else that somebody who's a little bit more connected to DC with somebody like Isaac on their team is going to tell them, hey, don't do this or do this because this is changing. So again, another key takeaway certainly is just to monitor your vendors, monitor your counterparties, monitor what's going on in DC. This is a rapidly changing mortgage ecosystem. It's more rapidly changing. I've been in this space 30 years. It's changing every minute. And Tyler and I were joking, like anything we just said, anything Isaac and I just said could have already been proven wrong in the 58 minutes we spent with you today. Isaac, any closing comments for folks?
No, I think the fourth takeaway for me has always been just listen to Seth. So that is my takeaway here, and I appreciate the invite. Thank you all.
Isaac, thank you again for all your time. Congratulations on your new role at PennyMac. As you know, many of our clients sell a lot of loans to PennyMac, so you're a new face for them. You may have sat in some meetings in New York with them, but we always appreciate you having on the panel. There is a survey, I think, that we would love to have you do, and if we can help you out at Richie May any way you can. And if you want Isaac's information, I will be happy to provide it as well. But Isaac's a great place of resources. Isaac, again, thank you for your time. Tyler, great job with the data. And you all have a great rest of your day. And thanks for joining our call.